This is Scott Becker with the Becker Private Equity Business Podcast. Thrilled today to be joined by Nick Stenger. Nick is sort of has his own family office. He's going to talk about what they do, how they invest, how they look at things, and a lot more. Nick, can you take a moment to introduce yourself and tell us about what you do?
Yeah. Hey, Scott. Thanks for having me on. Really privileged to be here with you. And we are a multifamily office. We're based out of Naperville, Illinois, suburb outside of the city of Chicago, where my family has been for a very, very long time now. I'm actually a seventh generation Naperville resident myself, and my wife and I, in about a week and a half, believe it or not, are going to be having the eighth generation right here in Naperville. And we're very excited for that. We've always kind of had this entrepreneurial legacy and kind of passing that down to the generations. And so what we've done recently, just about a month ago now, is we launched this family office to be able to serve our family better and many of our clients' families as well.
So how does a family end up in the Stenger family being in Naperville for 8 generations? What year does that take the family back to? Is that like the 1800s, or when is that?
Yeah, it's the mid-1800s, the 1850s, and it was the first generation of our family that came to New York City first. And then if you count back 7, then it was the next generation that was in Naperville and the German family. So they really don't know how to do a whole lot other than engineering and maybe some furniture making, but also beer brewing. And so that's what our family, they got involved with the brewery business, and that business grew over time and eventually ended up having a guy by the name of Adolf Coors as its head brewmaster.
Amazing. And I see some of the articles on it, from Stowaway to Brewery Magnet, tracing the history of Adolf Coors. Simply, literally amazing. And so the Stenger Brewery in the late 1800s, a rich golden history. What a fascinating family. So back in the day, so let me ask you a beer question. What's your favorite beer?
Well, I don't know if I'm supposed to say Coors or not. I do like Coors, and some of the IPAs have been kind of interesting to follow, but there's just so many breweries in the area. There's Naperville is just booming with them, and Chicago, of course, as you know, it's just there's a lot of entrepreneurs who have been able to make these micro brews, and the beer back then was a little different. It was really they even gave it to the kids because it was safer than drinking the water, and it served just a really interesting purpose back when our family was making it.
Fascinating. When you look at today, you now invest on behalf of the family, on behalf of others. How does that look? Is it a lot of alternative investments? Is it public equities, treasuries? What's the core holdings of a family office? How do you sort of look at that? How do you evaluate that and think about strategy?
Well, there's certainly a role for all that stuff you mentioned, Scott. There's alternatives that some people will use, but we focused on the core families. And I think what's happened in the wealth management industry, and the big reason we launched our business, is obviously the highest ultra wealthy families in the 50, 100 plus million range. They're well serviced. There's lots of people to serve those families, and a lot of them just create their own family offices. And then you've got people on the lower end of the spectrum who are just getting started, and they're just getting going with financial planning and investing, and there's a lot of great robos and all of that. What we fill the gap for is what I would call this middle zone, where people are 1 to 10 million, and they're starting to have more complexity than they used to. The net worth has grown over time. Back in the mid 90s, an average family would have maybe $500,000 all in at retirement. And then now that has grown to an average of about 2 million. And as we do our projections the next couple of years, the average family is going to need closer to 4 or 5 million, 15 or 20 years from now. And so as that's gone on, it's created this massive opportunity to serve the middle of America, where net worth is growing, complexity is growing, and we've put an entire team of experts. So one of the big things we do is we're big believers in dividend paying stocks, holding them for the long run, and not getting overly fancy or trying to time the market, but just getting people on a plan, using those dividend paying stocks, great blue chip US American based companies to do that. And then we've also put a team of experts around our families. And this is one of the areas I think a lot of people are missing, is they aren't bringing their tax person into the meeting every year, for example, or they might not even have a tax person that's helping them. They're not bringing their attorneys in the room to help with estate planning. Maybe they need to get a will or a trust put together. And so what we've done is we brought all these things like we used to have with financial planning and investment management now alongside a team of experts, so that you can take a family with that mid-range net worth who really needs to have all these things addressed and have an entire team of people at the same table.
Fascinating. And when you look at your business this year, what are you most excited and focused about? You just got it started not that long ago. How exciting is that? And what are you most focused and excited about this year?
Well, I think the first thing that we want to do is we want to make sure that we continue to maintain this awesome culture that we've worked so hard to build. We've got such good people on the front lines. We've got my business partner, Bon Roth, who's been a wonderful friend and great guide as we've gone through this together, and we've worked together for a while now. And then we've got our frontline people and our ops folks and the tax people and all that. But as we bring on new people, we just want to be so careful that we maintain the culture that we've worked so hard for. And I think, you know, culture is this intangible thing. You don't know what it is until you're in a bad one or if you're in a really good one. And so protecting that at all costs is so key, because then it ultimately flows through to clients. And when clients know that your people are being taken care of and that everybody's on the same page and everybody's energized and passionate about what they're doing, clients will feel that. And that's where I think this whole thing has to start.
Thank you. And take a moment on, when you look at finance today, you've got this fascinating situation. Interest rates are the highest they've been in a long time, about 20 years plus. Fed funds rates right about 500 basis points, 5% or so. The equities have elevated some in the last quarter, potentially in response to Fed rate hikes slowing, So when you look at that investment climate, how do you advise your customers? What are your clients? What are you looking at today, and how are you thinking about things?
It's an interesting environment. It's not something that's totally out of the ordinary. In fact, it's more ordinary that you'd have a 5% treasury than not have a 5% treasury. If you go back over a long period of time, 5-6% has been really a pretty good average. And you, of course, remember the 70s and the 80s when interest rates were spiking up to the 19 or 20% zone, and we had clients with 22% mortgages and 18% CDs and all the rest of it. And that, of course, has come down. The past 40 years, we have been on a bond bull market. Bonds have done incredibly well. And so when we were planning the 80s and the 90s and even the early 2000s for families, a 60-40, 60% stocks, 40% bonds, that mix in the portfolio just was wonderful. That produced great returns. And then you got to COVID, where interest rates were rock bottom, literally 0% there for a while. And the 60-40 had a couple of tough years. And I think now it's probably, in my opinion, not time to jump all back into the 60-40 right this second. We may have a little more room to run on rates. It's possible that rates, I think, could stay high for a while. Whether that's right or wrong, you could have a debate on that. But the reality is at some point that 60-40 will come back into favor. It will be a good option again for clients. And I think you just have to watch your risk. You have to make sure that you've got some good risk management in place. You want to make sure that you're not buying long-term bonds. Of course, that's what happened at SVB, that you're buying stuff that's going to be conservative as we go through these uncertain times. But you still want to have that exposure to equities. You want to have the U.S. companies that are paying dividends, because I think what people are looking for in a high-rate environment is they want current income. They don't want to have to wait 10 or 15 years to possibly get a return on a tech stock. They want to get some income, some return right now. And that's what we're doing for our clients.
Fantastic. And where do people find more about what you're doing, Nick? How do people find more about Nick Stenger and what you're doing?
Well, go on our website. It's www.stengerfamilyoffice.com. You'll find all of our information. We are big believers in education, so we've got a lot of articles and webinars and research that we put out. And then just like you, Scott, we've got a podcast, The Nick Stenger Show, where we talk every single week about the markets and different trends going on. And you can find that on Apple and Spotify and all the other places.
So one more question, and you don't have to answer this. Do you have a favorite stock? Is there a favorite stock that you have or not necessarily?
You know, I don't know about a favorite stock right now. I do think it is a stock picker's market, though. I think a lot of times people get into these what are called target date funds or maybe market cap weighted indices where they just hold on to the biggest companies just based on the largest, just the fact of size. And what happens, I think, when you're going through these high rate environments, you do need to be more selective. You need to be thinking a little bit more about what you actually own. I think a sector that we like long run is going to be the healthcare sector. And you've got an aging population. You've got a rapidly advanced medical system here in the U.S. We've got the best medical system. Yeah, it's expensive. It's got some issues with it, but everybody from all over the world wants to come here for important medical care. And just a lot of the population trends that are going on, I think really favor the healthcare sector. Again, we don't want to overdo it and put all of our eggs in one basket, but I think there's some wonderful names in that arena that will do very well the next 10, 15 years.
Fantastic. Nick Stenger, again, thank you so much for joining us. Amazing what you're doing. Thank you for joining us on the Becker Private Equity Business Podcast today. Thank you very much.